Wait, glasses or no glasses? No glasses. All right.
Okay, guys, we're live. So good evening, everybody. Welcome to our financial literacy series event, real estate as an asset class. So for those of you who are new to CAUFP, we're a member-based resource organization providing a link between corporations and also the Black communities through programs and education that promotes economic growth. Please follow our social media. We're on Instagram, we're on LinkedIn, we're on Twitter, we're on all the social media platforms, and also make sure to sign up to our newsletter if you want to find out about some of the other events that we have. They're all on there. So tonight's event is a panel discussion that will be followed by a question and answer session, and there'll also be networking at the end. So without further ado, I'll pass our event on to our moderator, Tomide Oleniyi.
Good evening, everyone. Thank you for taking the time to join us today. My name is Tomide, and I'll be moderating the event today. I have a background in civil engineering, and I currently work as a project manager in the land development industry in Ontario. Today, we'll be joined by 3 speakers who will provide insight on how real estate can be used as a tool to build multi-generational wealth. There are many benefits in investing in real estate, and some of those benefits include being able to generate passive income while owning an asset that will typically appreciate over time. It's an asset class that allows investors to leverage equity to make more investments, and it is a great way to lower the volatility of an investment portfolio. Each of our speakers will present for approximately 15 to 20 minutes, and then we'll open up the floor for any questions for about 20 minutes. Afterwards, we'll have a speed networking segment where you can jump in a room with anyone who joined in today. We have a lot of interesting people in the room who are making major real estate moves in the industry. We have investors and developers in this room today. So the speed networking segment would be a great way to connect with like-minded individuals. Our speakers today are Monique Johnson. She's the owner of Your Happy Realtor & Co., which is a real estate company committed to helping people build wealth through real estate. Monique started her career producing the international real estate shows such as Property Brothers and luxury real estate shows called Buying the View. She has also created a real estate web series called Newly Listed Toronto on YouTube. She's also the real estate expert on the national show City Line, hosted by the beautiful Tracy Moore. And she has flipped several homes with her husband, and together they build custom homes in Toronto. Afterwards, Kerry Escoffier will be speaking, and he is the founder of the Escoffier Group, which is a holding company with interest in real estate, electric mobility, and renewable energy. He is also the chief financial officer of Golden Triangle Investments, where he oversees special investments, acquisitions, and financial governance. He has over 10 years of experience as an investor, advisor, and asset manager in the real estate industry. Today, he's going to be providing insight on real estate market trends, more specifically, the areas that will likely see a real estate boom in the future. He'll also cover how to invest in development projects at the inception stage and the benefits of doing so. And our last speaker today is going to be Mutiat Bello, who is a former 9-to-5er who has turned into a real estate entrepreneur. She's a course creator, a wealth strategist, and a real estate developer in training. Her discussions today are going to be primarily focused towards people that are interested in investing in real estate assets as a strategy to build multi-generational wealth. I hope we are all able to gain knowledge today that we can utilize to build long-term sustainable wealth. Over to you, Monique.
Okay, thank you. Thank you, Tumine, for that introduction. Hello to you all. I cannot see you, but I know that you're here in spirit with us. I'm going to be sharing my screen now to go through my presentation that I've prepared that is going to speak to first-time home buyers. Okay, so we're going to start right at the beginning on how to get into the market, the process, and what you can potentially expect. Okay, so I'm going to share my screen now. Just give me one moment, please. Okay. Can I get confirmation that you can see what I have here? Hello?
Seeing your browser.
Okay, are you seeing the presentation here? No?
Not yet.
Not yet. Okay, 1 second. Okay. Does that work?
Yep, looking good.
Great.
Okay. First-time home buyers. I'm speaking to you all today, okay? I don't know if we can do a show of hands, but I can't see you, but it would be great to get an indication of how many people have not jumped into home ownership as yet, because I'm going to demonstrate why it's important to do so as soon as possible. Okay, so what you'll learn from being here today from me is a few things. So state of the market, what this means for you as a first-time home buyer, perhaps some limiting beliefs about becoming a first-time home buyer or a home buyer period, buying, what you can expect through the process, leveraging your equity as an existing homeowner. This is going to be very, very brief because I know another speaker is going to be covering this topic. Home ownership leads to financial freedom. Again, that will be spoken about in a brief context. And then finally, limiting beliefs revisited. What is stopping you from jumping in? Okay. So we have to give context to everything. So I like to start by discussing what has happened pre-pandemic, where we are now, and what this means for you. Okay, so we're going to go into a little bit of context sharing right now. So what has happened and where are we at now? So pre-pandemic, within the last quarter of 2019, the market made a slight comeback from a stalling performance impacted by the stress test and foreign buyers tax introduced in years prior. Okay, so those measures were brought into play to kind of cool the market. At the time, in 2019, in October, the average price was $852,000, a modest increase from the year before of 5.5%. The consistency of buyers outnumbering sellers, as well as a free flow of high-skilled, high net worth immigrants, helped fuel this modest growth as well as a recovering economy. Okay, some more context for you. So March 2020, the pandemic hit. The market halted, panic ensued, and lockdowns were in effect. The Bank of Canada then shortly after introduced a historically low mortgage rate under 2%. Some banks offering rates under 1%, which is unheard of. So naturally, as the market goes, human emotion is evoked and the market responds in an unprecedented way. People begin to rethink their living situation and new work from home culture is becoming normalized. Buyers are outnumbering the listing inventory available, and prices begin to soar in some areas beyond the 35% mark based on the sales from last year. So now the new average price in 2020 in April is $1,090,000, up 33% from 2020. Okay, low borrowing costs combined with low inventory, combined with working from home culture, combined with people rethinking their lives overall and their homes have triggered this growth. There's now talk of another stress test that's going to be taking effect June 1st, 2021. And so the speculation is beginning again. There is also more talk of a foreign buyers tax and other measures to help cool the market. The market has begun to cool slightly. It's not identical to what we saw in years prior when stress tests were introduced, but it does feel familiar, okay? So what I want you guys to do now is to really, take a moment, reflect on your big why. Why did you come today? And if you're not a homeowner already, I want you to think about what might be stopping you from getting into the market other than money. Okay, so I just want to repeat that. What might be stopping you from getting into the market other than money? What's available for you as a first-time home buyer? There are several incentives beyond this list that I have curated here, but there are others that are not as significant, but these are the most significant incentives. Okay, so right away, right out the gate, we have the RRSP's Home Buyers Plan, and you can borrow up to $35,000 from your RRSP toward your down payment. There is a land transfer tax rebate, and you can receive a portion of your land transfer tax back. Just to give you guys an idea, land transfer tax costs go anywhere from 0.05% to 2%. First-time home buyers incentive. The first-time home buyer incentive is a shared equity mortgage with the government of Canada. So essentially, they will kick in some money towards your down payment. Okay, and you can see the various types of scenarios and the amount that they're willing to offer you here. Okay. All right, so I want to revisit this part because I see this a lot in our community and in other communities, but there are limited beliefs around home ownership, and really I see real estate as a birthright because it is a guarantee, especially in this country, that you're going to do well. So I really want to help strip some of the limiting beliefs around why this may not be possible for you. This is our fundamental belief, and I lived through this. Anything you want for yourself and your life is available. So start right here in the present moment and look around you. Well, I can't see you, but you can look at the other participants in this group. Because you're in the presence of like-minded people who also share your desires. So where you are right now is perfect. And we do sincerely care about your futures. And as a team, we want to help you get wealthy. Okay, so for me, my story, I started out investing in real estate over 10 years ago, and I started out with $6,000. That's what it took for me to get into the market, but I also partnered with somebody at that time. Okay, but we'll talk about how there was other avenues for you to get into the market other than having to rely on solely yourself. Partnership is perhaps your best tool to get into the market right now if you can't do it alone. Okay, so now we're going to talk about the process of buying a home. Okay, this might sound very familiar, or it might sound, some people may have this down packed in their minds, but there are others who may not have it. So I would like to share this information with them. Okay, so buying a home. The first step in any process of buying a home is to go through the mortgage application process before you meet me, or it can be in combination with me. So either I can introduce you to a mortgage broker, or you can perhaps find your own mortgage broker. I like to work with brokers who I know. So if someone is to work with me, they would be working with my team. Okay. So in terms of how this process looks, if you are an employee, let's look to the left of the screen here. Okay. So these are the components of what you would expect to submit to your mortgage broker or bank in order to get qualified for a mortgage. Okay, so you're going to have to fill out a mortgage application, sign a privacy form. You're going to have to submit your last 2 pay stubs, job letter, your last year's T4, 2 years T4 if we're using your bonus or commission income, mortgage statements if applicable, right? Property tax bills and copies of leases. If you're self-employed like myself, this is what you're going to have to submit here on the right-hand side of the screen. So you're going to have to ensure that you have a mortgage application filled out, of course, privacy forms filled out, your last 2 years T1 generals and notice of assessment, last 3 years financial statements, mortgage statements, property tax bills, copies of leases. So the criteria is slightly different for people who are self-employed versus people who are actually employed through a company. So once you've gone through this process of the mortgage application process, okay, you may get a negative feedback. And your mortgage broker or lender may say to you, you're not going to be able to qualify on your own. However, have you thought about partnering with other like-minded people, whether it would be your circle of influence? So I'm talking about your friends, your family. It could be your coworkers. It could be people a part of this wonderful organization. The best way to get into real estate as fast as possible is to do it with other partners, and you will go farther using that strategy. And I'm going to revisit this again. And this means aligning yourself with like-minded people. So if people are in your circle who may not have, who may not be qualified to partner with you, what I would offer is to look at meetup groups. We're in the digital era right now where you can meet people online. And I know that might sound strange. You might meet someone online and may want to buy a house with them. No, it doesn't work that way. Obviously, there's some kind of trust and rapport building that's going to happen. And in addition to that, there will be obviously heavy legal contracts in place to protect each party. Okay. So you've done your review with your mortgage broker. They've given you an approval. So what does that mean for you now? So that means you and I are going to start doing business together, and we're going to be working very closely with one another so that we can get you in the door, okay? So you qualify for a mortgage to purchase a loan or with a partner. Now what? You need to hire the right dynamic and persistent real estate salesperson to represent you. Our role as realtors is to protect your interests at all times. We have a fiduciary responsibility to always protect your interests. Okay, so here are some criteria that I think are important for people to consider when they are hiring somebody, such as myself. So you want to make sure that person's knowledgeable, they're experienced, they're available, they're a homeowner or investor themselves. I'll tell you a funny story. When I was shopping for my first home, the realtor that we had found online, she didn't own a home and she'd never been through the process. So, that eroded trust for me. I wanted to work with somebody who had been through the process extensively. So it's important the person you're working with has a lot of experience under their belt. A brilliant problem solver is another characteristic that's important. Someone that's a strong negotiator who can persuade and influence. Also, empathy and compassion are two elements that I think is key, especially when you're working with first-time home buyers, because it is a scary process. It's overwhelming. It's all new. So you're really going to want someone that's going to be nurturing and really hold your hand and be your best friend throughout this process. Someone that has a reputable track record, connected to the trades, mortgage brokers, legal, lawyers, and inspectors, okay? So I don't want you to underestimate this part. Someone that is connected to the trades. In this market, a lot of people have had to make a lot of adjustments to their expectations and the type of property that they would be eligible for. A lot of my clients right now are buying properties that need work, okay? Because they now have been priced out, unfortunately. But there's ways around that. If you are connected to a realtor who has connection to the trades, because if you're working with contractors who are not reliable or know what they're doing, it can become an even more costly process. I've seen it happen, and it can be a disaster. Okay, so this is an area that I don't think gets enough credit. Realtors need to be connected to the trade so that they can then empower their clients to purchase properties now in this market that may need some fixing up, because that's a reality right now. Okay, so once we have started our contact and our conversation about your goals and aspirations, that will roll into a consultation, and we'll learn about what's important to you, your wants and desires. We then narrow down the area where you want to live. I urge you to be flexible, okay? Every client of mine has had to make an adjustment this year because of how ferocious and aggressive this market is. So being flexible is what's going to save you heartbreak. Make an offer. Then the next step after that, we will make an offer on the home that I have found you. Of course, we're going to be looking at what the seller situation is. Even though we are in a seller's market, there are still opportunities out there, right? So as a savvy realtor, there's clues and hints that can showcase the seller's vulnerabilities. And what we want to do is capitalize on those vulnerabilities for your benefit so that you can get the home for the best possible price, okay? The next steps, we do our due diligence, okay? So within the offer, you know, in a normal market or balanced market where we're not in this situation where there's multiple offers on mostly everything, doing our inspections, when I talk about financing and inspections of the actual property, those steps have to be taken in advance. And what I mean by that is a lot of properties are being sold in multiple offer scenarios. I know everybody has seen the headlines. So in that competitive situation, we want to make sure that we have our due diligence done ahead of time so that you're in a winning position. And that even includes status certificate. So for those of you that may not know what a status certificate is, that is essentially a report card of the condo management company and how well they're caring for that property and managing the finances. So if you're working with a savvy realtor, they'll be able to know that these elements have to be done in advance so that your offer is a winning offer on offer night. So after we've done our due diligence and we've submitted our offer, the seller will then accept our offer and then the sale becomes firm, okay? So this doesn't apply, but this is typically how it goes after sale becomes firm after a due diligence period. But that not in this market. So then we will wait for your closing on your new home. And then I will guide you through introducing you to a lawyer who's gonna close your sale, but also help you do some estate planning. So with my clients, I always stress the importance of once you've made your purchase, the second thing you need to do is get a will so that you can pass on that asset should anything happen to you. We don't know what may happen, but we live in a time where life is unpredictable. We have to prepare, and this is how we truly empower our community and our generation. You know, it aches my heart when I see certain things online, like GoFundMe accounts and so on for people that have passed, because there's so much information out there to protect people's asset, as well as, you know, even if you don't have a property, there's life insurance that, you know, will also be passed on to the next generation to empower them. It's just information. People just need access to the information, okay? So once we've closed, you have your will, we will celebrate. I want to show you guys what you can expect in terms of closing costs for buyers. So there is legal fees involved in closing your sale that can range anywhere from, you know, $900 to $1,500. I've seen prices as high as $2,000. So the second line here refers to interim occupancy. So if we're dealing with a condo property, not a freehold property or a new build, there is going to be a interim occupancy period, which includes a status review and new contract review period, okay? The next thing is land transfer tax. So if you are going to be taking advantage of the first-time home buyers land transfer tax rebate, which I showed you in my earlier slides, this can potentially be knocked down significantly in terms of the cost. It depends on the purchase price, okay? And then if you require a mortgage that is not insured, so that means if you're putting less than 20%, you're going to need CMHC insurance, which can be hefty, but you can blend it within your mortgage payments. But that is something you're going to have to be responsible for on closing, or you can blend that insurance premium into your payments. Also on closing, you'll be responsible for the remainder of your down payment, okay? So the minimum down payment is up to 5%, but most people do put a little bit more than that. So you will be responsible for putting down the rest of your down payment. And then you're going to be paying for the registration of the mortgage, transfer or deed, and then title insurance, which will protect you, okay? So in addition to the previous slide, here are other elements of what a real estate lawyer does do. Okay, so they prepare signing documents. They prepare mortgage documentation. So they communicate directly with your lender, and your lender will provide instructions to the lawyer as to what they're going to have to do in order to get your sale closed. And again, here you're going to be attending the office to review your closing docs, and you're going to sign on the dotted line, and then you're going to get your keys to your new place. So how much should you save for your purchase? So a minimum of 5% of the purchase price is what you should be providing, okay? Okay, so once you've purchased your property, now it's time to think about, especially if we're in a very strong, high-performing market, how you can now leverage your asset as an existing homeowner. And I'm not going to go too deep into this because I know that there's another presenter that's going to cover this, but I just wanted to share some more information about this. So leveraging equity. Okay, so there are two ways to build equity when you own a home. The first is paying down your mortgage every month, goes toward your principal and interest. The second is price appreciation, like the cost of goods and services we use. They go up over time. The same principle applies to home prices, which is the beauty of real estate. When your home appreciates year to year, your equity can be used as your tool. Okay, and you can use that equity to really fund the life of your dreams. Other investment properties, I've seen people use their equity towards buying vacation homes or paying for their children's education. Home ownership leads to financial freedom. Okay, home ownership leads to financial freedom. I have invested in real estate for over 10 years. And, you know, my husband and I have done very well because we live in this great country that has one of the strongest markets in the world. You know, we've now been able to leverage all of our moves that we've done strategically over the years to get to the point now where we can, you know, independently fund our own custom home building business. And this is simply because we were able to leverage that first property that we each had a property, but we were able to leverage our properties, combine it into one, and be able to leverage that bigger pot into bigger and better things. So owning properties that pay for themselves are investment properties that should break even for you. In cases where they don't break even for you, which means that the rent that you're collecting does not cover all of your expenses, even if you're paying a couple $100 a month, depending on where that property is and the neighbors and the neighborhood and features, it might be worth it to be paying a couple $100 out of pocket every month to cover the cost for your rental after you collected your rent. You will get to the point where your property breaks even for itself, but just to start off, it's okay paying a little bit out of pocket to maintain the property and the asset. Owning properties that provide passive income equals cash flow you pay for your lifestyle, okay? Real estate is a long-term game, so you wanna buy and hold, okay, depending on your strategy. The strategy that my husband and I have employed has been solely around raising capital. So we've done a lot of flips and invested into projects that will generate capital in the fastest way possible so that we can then roll that capital into our custom home building business, okay? Under our current mortgage rules, partnerships are becoming very common. Listen, I know real estate's expensive, depending on, especially, you know, if you want to be within the GTA, but also now cottage country, because cottage country is now booming as well because of the pandemic. But I see this all the time. I've seen up to 5 people purchasing one single property. There is nothing wrong with that, okay? So partnerships are becoming very common, especially within the last, I would say, last 6 years. I've seen more and more of this because of the increasing house prices. The great thing about equity is you can reinvest it. You've earned on appreciating assets and not spending it. That's another option. I believe in taking equity and reinvesting it. I don't take equity out of my properties to buy lavish things or take lavish vacations or anything like that, but it's really used to reinvest into the business. So I really want to have you guys think about, what does being financially free mean to you? If you had all of your bills, your personal bills covered by, let's say, a portfolio of rental properties that you own, right? You're financially free. What does that open up for you? If you did not have to worry about paying a bill ever again, what does that mean to you? What would that mean for your family? Does that mean more time with your family? Does that mean that perhaps you can then go on and take on that philanthropic endeavor that you dreamed of? Does it mean traveling the world? We want to get you to this point, being financially free. We all deserve that, and we can have it. So in buying real estate as a first-time home buyer, you're buying with the intention to roll that first purchase into several so that you can pass it on to the next generation so that our community can be empowered, okay? So generational wealth is key. So first is what future are you building for the future generation, okay? Second, you build generational wealth by acquiring generational assets that you can leave to your heirs. So that means the people in your family, the people you love, who you will leave your assets behind for. Types of generational assets. So dividend paying stocks, rent real estate, or businesses. The best way to leave a legacy is through generational wealth, okay? So for those of you who are engaged in this presentation, I just want to revisit this point again. Limiting beliefs. What is stopping you from making your move? Okay, so it's important that we focus on the why, not the how. The how will always take care of itself. I started out with $6,000, and I had to buy outside of town to be able to get into the market. I bought a townhouse. We paid about $262,000 in Ajax at the time. I know we don't hear of those prices anymore, but that first opportunity got me in the door, and from then I became unstoppable. Okay, it's time to discover what's stopping you. Let's take money off the table. What is stopping you? Because I find in certain communities that there is a limiting belief around being able to access this pot of gold that's here for all of us to enjoy. Generational wealth is a birthright, and it's the way to leave your legacy. And here is another thing. Waiting and timing the market. I hear a lot of this as well. That is really fear. That is not about timing the market. Nobody can time the market because we don't know what's going to happen to the market. We don't have a crystal ball. We can forecast, but really, we really don't know. What we can do is predict based on past trends. And what we've seen is whenever the government has intervened in some kind of way, whether it's a stress test, whether it's introducing a foreign buyer's tax, that's when we see the market kind of take a stumble because people are speculative. They're speculating. They're waiting to see what's going to happen. If you have a heart, if you have a heart to really experience and be able to pass on wealth, you have to just jump in and you got to do it now. Okay, the time is now, and we're here to guide you through every step. So I am complete my presentation. If you guys have any questions, I will be here after for a little bit to answer. Okay, thank you so much.
That was excellent. Thank you so much. You provided a very detailed pathway to home ownership as a first-time home buyer. And I hope anyone that's looking to get into the market will utilize the insights that you've provided today. I'm sure a lot of people are going to have questions, but we'll get to that in a bit.
Thank you.
So we're moving over to Carrie.
Great. Let me share my screen. While I'm sharing, I can't see anything. So can somebody just give me a yay or nay that you can see the presentation?
No, we can't at the moment.
Nope.
We're currently looking at your browser.
Okay, 1 second. How about now?
Yes.
Yeah. Okay, great.
Looks good.
Perfect. So thanks again, Monique. It's very reminiscent of, how I entered the market in 2008. And I'm going to speak to a bit of my evolution and how I got involved in real estate and, ultimately got into real estate development. So I think that was a great, a great segue into this, industry of within the real estate market. So disclaimer. And I know Lindsay's in the audience. She's a securities lawyer, so I'm pretty sure she'll appreciate that. We operate within the exempt market regime. For our projects, we do raise private capital, and so it's a very strict regime when raising capital. Always have to present a disclaimer. What I'm going to be presenting is not an offering to invest with us. There's a very strict process that individual investors would have to go through and be screened through in order to participate in the investments that we offer. So our evolution. Golden Triangle Development is really the culmination of a group of friends that just after university started acquiring real estate. In 2008, the principals of Golden Triangle Development began purchasing real estate with a focus on pre-construction condos. At the time, we thought prices were high, right? And it kind of alludes to what Monique was explaining, where you never quite know the right time. But we were purchasing condos in the Toronto downtown core at about $250,000 at the time. In 2009, while purchasing assets that were really for the future, right? Something super passive that we can acquire, build equity over time. We started to see real estate as a tool to generate cash flow. And so in 2009, we began purchasing multifamily income generating properties just outside of the GTA, primarily Hamilton. At the time, Hamilton was a burgeoning community or burgeoning city just outside of the city of Toronto. We were purchasing what we could at the time. That brought about its own headaches, managing properties that we had to renovate, as well as managing portfolios where you're dealing with multiple tenants. In 2011, after acquiring that portfolio, we really developed like an internal skill set with respect to revitalizing and renovating those properties. So just by chance, because there was a need to renovate the properties that we were acquiring, we developed that skill set. And so we started acquiring properties with the intent to actually renovate them and sell them. All of that really culminates in where we are today. So today we are a developer of multifamily and commercial retail properties. We leverage the experience across this value chain that you see here. From the early days of purchasing pre-construction to where we are now. Each of these steps plays a very significant role in the capabilities and the investment projects that we do now. So just speaking to the development cycle, at the beginning of the development cycle, you have raw land. Raw land is land that may not necessarily be zoned for any particular intent. At that point, land is relatively risky. Because in the development space, ultimately, you have an end goal of developing a piece of property to your expectation. At the raw land phase, there's quite a bit of risk there because you're not quite sure whether you're going to achieve the zoning requirements that you need to develop what you want, or go through the entitlements process with the municipality to develop what you want. We particularly don't enter the development cycle at this phase. We typically enter at the next phase. So in the next phase, you're ultimately zoned. That means you have an understanding as to whether you can develop a commercial property or a residential property, and to what sort of density you may be able to develop a property. At this step, the next thing that you really need to do is what are called entitlements. That is reaching into the planning office, the municipality, and trying to secure various levels of approvals to actually build the plan. So still a bit of risk here, because you may go through several iterations of those plans before you get an approval from the municipality to actually build what you want to build. The next phase of that cycle would be construction. So once you have, once your site plan approved, once you have a building permit that's approved by the municipality, the next step is actually to get on the ground and build. Again, a little less risk because now you at least have a plan. You know what it is that you want to build, and ultimately the risk that you're taking on at this point is the construction risk. Can you actually deliver on executing and building the property that you intend to? And then finally, you end up with a developed piece of real estate. This could be, a condo development. It could be a commercial retail plaza. It could be a multifamily apartment building. Wide array of different type of real estate assets. Again, we're particularly focused on multifamily and retail developments. So our process, we really start with assessing markets. What are the markets that we want to participate in? What are the markets that we want to invest in? We typically look at things like population growth, vacancy rates. So, there are several reports available in the market where you can actually assess what the vacancy rate is in an income generating property that's made available for rent. For instance, with a multifamily apartment building, you can get a sense of what percentage of the time over a given year is a specific unit type within a market vacant. There are PR ratios, which are another good indicator for markets that we want to participate in. PR ultimately stands for price to rent ratio. It's simply dividing the purchase price of a piece of real estate divided by the annual rent that you can charge for that real estate. It's somewhat of an indicative type of number to rely on, but it can help you assess whether there are bubbles or highly speculative markets. And so we tend to stray away from some of those, and I'll get into some of the markets that we participate in. Income and income growth, right? So, Monique actually spoke to, markets and markets growth and the impact on appreciation for real estate. Several of these factors actually play into the appreciation of real estate. Like any other asset, it really is a function of demand and supply. Of course, land is in limited supply. They're not making it anymore. And so, you already are kind of on this footing in which, you're really assessing what the demand for property is. And that's where population growth, vacancy rates, and income growth can give you an indication of what demand is like in a market. And then finally, the demographic. Who is the population that you're actually serving? That really goes to, indicate what type of property you should actually be building. After kind of doing that, more macro market analysis, we do a deeper dive into the local market. So once we kind of assess where we are, now we're dealing at the neighborhood level. The pocket in which we're looking to invest, we look at things like what is the access to adjacent markets. So typically the municipalities that we invest in are just outside of the city of Toronto. We know that the city of Toronto is the core. That's where a lot of business happens. That's where a lot of activity happens in general. And so, access and easy access to those core markets is something that goes into our analysis. Proximity to subdivisions and retail nodes. So what is the access, or how close are you to subdivisions? One of the projects that I'm actually going to show you as a little bit of a case study is a commercial retail plaza. Having an understanding of who you're actually going to be serving in that surrounding market is vital to determining exactly what you want to build and whether there's actually an opportunity to build what you want to build. And then surrounding development and development plans. So you can always check in with the planning office of the municipality to see what sort of approvals developers are actually trying to achieve, and it'll give you a sense of what the future of that market may look like. The next phase, kind of going through our process, would be development assessment. So again, kind of looking at the cycle that I showed you before, at what point or at what phase are you in this development cycle? Again, we particularly enter at the point at which something is moving along the site plan approval process, just because it tends to de-risk the project a bit, but still gives us some latitude to have some free reign in what it is that you actually want to deliver for that particular market. Entitlement requirements. So these are all of the requirements that the municipality is going to need in order to secure those approvals. You need a host and cast of many in order to secure these things. You need to engage planners, a number of consultants ranging from environmental to hydrogeological, topographical, arborists. One of the projects that we're working on right now, we're spending a lot of time understanding trees in the area and the impact of those trees. Can you remove those trees? Should we be planting more trees? These are the types of things that actually go into being able to secure approvals with the municipality. And then some of the more common consultants that you probably expect to be more prevalent in a real estate development, architects, engineering, civil, electrical, mechanical, and the like, right? These are all consultants that you would need to retain in order to put forward the necessary documents to secure the approvals that you need to develop what it is that you want to develop. Financial analysis. So I am a finance head. There's a few hats that I wear across a few different businesses, but the common function for me anyway is on the financial analysis. And what I've found in real estate is, it's very similar to putting or assigning a valuation to any other asset. For us, we are very much fundamentalists in our approach to valuation and what a property is worth. And I'll get into to what that means and how we go about assessing a value to a piece of real estate. So through that process, it's very important to understand what the market rents that you'll be able to attract are if you're building a multifamily property or building a commercial retail plaza. Kind of going back to vacancy rates and understanding what percentage of the time you expect these units to be vacant or tenants to kind of be in flux is an essential part of understanding what your income generating potential is. Understanding what your operating expenses are. Operating expenses range from your annual realty taxes to maintenance costs, insurance. All of that kind of culminates in understanding how a property operates, the income that you are able to generate from rents, less the expenses that are required to maintain and upkeep that property. After doing that analysis, you arrive at what's called net operating income, which allows you, for our purposes anyway, to do a valuation assessment. When it comes to commercial real estate development or income generating real estate, it's much more of a science in arriving at a value of a property than it is an art. And I think that's one of the things that someone like me was attracted to. On the residential side, although we participate there and have been investing, it is somewhat speculative. You may be looking at comparables to assess what the market value of a particular residential property is. I'm sure you've probably all seen that sometimes those markets are not super rational, or you can't quite understand, how values are arrived at. In the commercial space, I say it's much more of a science because developers, investors in commercial income generating properties typically look at a property in the same way. The value of that property is really a function of the net operating income that you can produce, right? When you're investing in a piece of real estate, what is valuable to you as a developer or as an investor is the income that it can produce. And so when you arrive at a net operating income for that property, you can apply what's called a cap rate, which is just an unlevered yield or just a cash on cash return on that property to arrive at a valuation. I know that's a lot of words to explain something that many people may not be familiar with. But happy to dig into that a bit more in the once we kind of get through this presentation. But again, the key here is arriving at a valuation for income generating property is much more a function of income, expenses, and what your expected yield on a property should be. And you can actually arrive at a valuation of say $5 million, right, on a property. And many people will regard that valuation in the same way. And so you're not really in a guessing scenario. And the opportunity really becomes, are you able to create additional income or create efficiencies that reduce expenses that give you a more favorable valuation than somebody else may be looking at the property at. And I'll get into that in a bit. And then you can always validate your valuation, right? Like my valuation may be very different from someone else's valuation. And so there are appraisers that you can hire to also give their third-party, non-biased opinion of the value of a property that you want to develop. Next part of the financial analysis is really the development budget. Assessing what your land acquisition costs are, right? And it's Monique alluded to all of the costs that come along with closing on a property, whether you're property or purchasing land. You are not only purchasing, or the cost is not just the land. You're also going to incur land transfer tax. You'll also incur legal costs. You may also incur, a prorated share of the realty taxes that are paid on that property over the course of the year. So, when you are looking at a piece of land and you see a price, understand that there are going to be other costs associated with actually closing or acquiring that piece of land. The next cost, set of costs that you need to assess are the soft costs. These are typically the consultants that you're going to need to hire to assist you with the entitlements phase that I spoke to in the development assessment. Then you get into hard costs. Hard costs are essentially construction costs. So what is this property actually going to cost you to build? Development charges or charges to kind of recoup on infrastructure costs that your piece of property will impact once you develop the property, right? So you will need to pay development charges to the municipality to compensate them for the fact that you are adding load to the general infrastructure, the general infrastructure in the market that you're investing in. And then the cost of financing, right? So, we use a combination of equity and debt to finance our projects. And so you need to be very much cognizant of the time associated with your development, because time is money when you are borrowing money. All of that really gets us to what's called a development spread analysis. And that's kind of the basis for our development projects. We acquire properties where we can acquire properties. On the development side, what we're trying to find is a situation in which the cost of building that property is less than the cost of the market value of that property. So in the example that I'm going to jump into, we estimate that the total project will cost us about $4.8 million. But once it's completed, going back to our income approach and evaluation approach, that property can be worth, $5.6 to $6 million, right? And so what you're doing is forcing value, right? You're building something in a market that has a higher valuation than the costs associated with building it. And then all of that just kind of gets us to, do we go or no go? And there are many more no-goes, super exciting projects that we thought we were going to do, but after kind of going through iterations of this process, realized that we don't move ahead. And there are the lucky ones that actually kind of get through the pipeline and we do move forward with. So I thought it would be kind of cool to, all of that is, all well and good, but I thought it would be really interesting to give you a live case study. So this is actually a development project that we're currently working on, and I'm going to, kind of take you through the steps, and it will tie back to the process that we just spoke to. So this is one of our flagship projects that we're working on this year. This is in Bowmanville. It's a commercial retail development opportunity. So it's about a 10,000 square foot, one-story commercial plaza. It has anywhere from 5 to 7 commercial retail units. We can adjust demising walls within the space to accommodate up to 7 tenants. We're currently 100% leased. So, before it's even built, and you'll see the plot of land that we have right now, we've managed to solicit significant interest from tenants who are already willing to occupy the space based on spec. There's no common space in this plaza. So ultimately what that means is, patrons of the plaza, those entering the units kind of enter directly into the respective tenant space. There are no common areas like hallways or corridors that you would see in a mall like Yorkdale. These are triple net leases. So in a commercial, in the commercial sense, leases work a bit differently. You not only pay what's called a base rent for the space that you occupy, but you also get to pass all of the taxes, maintenance, and insurance that the landlord would incur onto the tenant. And so it just creates another opportunity to recoup on some of the higher costs associated with the investing in the commercial retail space. So again, like I alluded to, the project is we've costed it out at about $4.8 million, but when we do our valuation, we see a significantly higher value than that when we assess the market valuation, and therein is the opportunity. So again, kind of looking at the development plan, we would work with a number of consultants to assess this piece of land that we have. What we've landed on is this 10,000 square foot retail plaza with 56 parking spots. And again, this is after iterations working with your consultants, going back and forth with the municipality to arrive on the necessarily site plan approval that you'll require from the municipality to actually execute your project. So this is the piece of land. Again, it's in Bowmanville. This aerial kind of gives you an indication of what is surrounding, right? So when we talk about that local market assessment, this number 1 box here represents the piece of land that we acquire. And then you can see a number of, surrounding retail, surrounding employers, direct access to the highway, all features that kind of lent itself to us investing in this particular property, in this particular local market. Looking at the market as a whole, so Bowmanville, growing population, it's been growing, at a rate of about 9% year over year. And it's relatively dense for a community outside of Toronto. So it's about, population density is about 1,200 people per square kilometer. And it boasts a young to middle-aged demographic. It's got a growing population and income generation. So at the macro level, again, when you're selecting markets that you're interested in, these are kind of high-level factors that can give you an indication of where that market has the potential to go. Zooming into the local market again, this black marker represents where we are. And within a 3-kilometer radius, you can get to other major retail nodes. There's several residential developments coming into the area. So again, when you think about building a plaza, your main consideration is who are going to be the patrons of that plaza. Although you may not necessarily be the one operating a business out of your own plaza as a landlord, what you are primarily concerned about is your tenants' ability to run a successful business. And so understanding their business model and what they're looking for is crucial. So when there is a lot of incoming residential developments, you understand that to be incoming demand. And so placing yourself in a community where you will have the ability to serve a new neighborhood is typically one of the things that we're looking for. And again, this is just some of the surrounding residential development coming into the area. So not only do you have a number of employers that surround your plaza, you also have this incoming residential that you will service as well. Right across the street from where we are, there's actually 2 existing hotels and an approved hotel coming across the street. So we are flanked by these three hotels. Again, what you're looking to do as a commercial plaza is create an offering to this surrounding development and existing development. So we've gotten significant interest from breakfast spots. Those that are interested in being able to service the hotels. We've gotten significant interest from daycare centers because again, there's this incoming residential development coming in. We're right next to the highway, so as parents are beginning their daily commute into the city, but they can drop the kiddies off very conveniently and make their way. So, it's not just about creating a piece of real estate. It's about servicing a community and understanding what the needs of that community are, and that should be the guiding principle in what it is that you're aiming to develop. And again, just some more development happening in the area. All really good signals of the direction of this market and where it has the potential to go. We look at things like market access again. So again, this is just looking at transit running through our site as well as a 60-minute drive time. Getting to other neighboring cities like Toronto, Mississauga, Peterborough to the north, out to Cobourg to the east. you have to do an assessment of what your competition is. So we look in the immediate area to similar plazas like our own. Fortunately for us, there really isn't much, really within our vicinity. Within a 3-kilometer radius, you start to hit some others. But what this can give you is an indication of, what the going market rent is in those areas. So, looking to MLS to see what, these particular landlords are receiving in rent from past leases that they've entered into is a good indication of what you may be able to charge. And again, that's very important when putting together your income assessment and ultimately the valuation on that property. Opportunities. So again, when it comes to building a commercial anything, right? It's really about income. It's not so much about the hardwood floors or the granite countertops. What you're trying to do is create as much income generating potential as possible. And that ultimately has an increases the valuation of that property. So when I say that, when I look at a property, or our team looks at a property and we look at the income approach, the income that I believe that I can generate from this plaza may be very different from someone else's. And so, looking at unique opportunities like on-site charging or electric vehicle charging has kind of become a new way of creating revenue. And so we look at a wide array of different income generating potential because, again, that improves or increases the value of your property. Other things like billboards on the top of a building or cell phone towers on the site of a property are other unique ways to create additional income beyond the traditional tenancy. So when you look at a property like this, the strengths and weaknesses, right? And so there's, you're never going to get the perfect anything. And so, when we acquired this property, it was well into the site plan approval phase. So, we were very happy with that because it de-risked the project. You have a general sense of what it is that you are going to be able to build. And, we were able to kind of work within the lines of what had generally been approved to adjust it to our particular needs. We're in a growing market with significant retail interest. I think you would have seen a relatively small sign on the land. That's the only marketing that we did here. We didn't have to engage commercial realtors in order to solicit tenants. We're in a very high traffic area, and our phone has been ringing just from that sign in particularly tenants that are particularly interested in the property. Highway accessibility and visibility. Again, we're right next to the highway, which is bodes very, very well for us. And then the surrounding employment and incoming residential subdivisions. On the weaknesses side for a project like this, we're lacking an anchor tenant. An anchor tenant is a larger tenant like a Walmart. Other tenants typically like an anchor tenant on site. Because a Walmart will have its own draw to that site, and other tenants will kind of be the residual beneficiaries of that traffic. A site like ours is relatively small, and so we can't accommodate a large anchor tenant like that. But on the flip side, one of the things that we've seen is neighborhood plazas with a relatively smaller unit footprint have been resilient in the pandemic market. Right. So, we've seen a lot of box retailers, larger footprint box retailers, really hurt by the pandemic. And so, very struggling businesses. But when you look at neighborhood plazas that are servicing nearby communities, restaurants that offer takeout, 1,500 square feet, they've been particularly resilient. And so in this market and haven't suffered the same sort of consequences of the pandemic as larger footprints. So again, kind of a trade-off there. And then of course we're in this softening retail market in just the general current market that we're in, caused by the pandemic. So I won't spend too much time here kind of looking through the site plan, but kind of looking through timelines. A project like this, we would have initially started looking at it in November of 2020. Conducting our preliminary analysis, putting in an offer by December, completing our due diligence around the February timeframe, closing the transaction in March. And if it wasn't for some of the construction shutdowns that we're seeing, we would have been in the ground already. but we're a bit delayed on that front, just because in non-essential construction is not permitted to move forward right now, given the current lockdown. So hopefully that's lifts for us soon, and we can put a shovel in the ground. We'll be able to turn the property over to tenants by November if we can keep to our existing schedule, and have a fully operational property available to the community by June of next year. Won't spend too much time here, but ultimately you need to fund your project, right? It's going to be a combination of debt and equity to do that. And then this is just a breakdown of how those funds get used. So once you raise the money necessary to develop this piece of property, the use of funds, of course, the land itself, the hard costs associated, the soft costs working with your consultants, and then carrying costs kind of make up the use of those funds. Won't spend too much time here, but ultimately this just arrives at what our projections are and what our investment metrics are for a property like this. This shows what we consider to be the base case scenario. This is if we have the opportunity to go beyond just the general tenancy of a plaza. We have an opportunity to put a cell phone tower on site. We manage our vacancy really well. And we see the general appreciation trend that we've seen in this market over the last 5 years into the future. These are the projected yields that we see to ourselves and to our investors in a property like this. And that is the end. I think we're holding questions to the end. But yeah, again, happy to discuss this process with you. What it is to get into development, and how to assess a commercial retail development.
That was great, Kerry. Thank you for your presentation. You covered the full cycle of the real estate development process and all the things to consider in each stage, from purchasing raw land, the challenges of going through the approval process to get land approved for your intended use, and all the considerations that should be taken into account when choosing a product type. I currently work in the land development industry, so I'm well versed in the development and approval process.
Awesome.
But I love that you provided an in-depth analysis of the financial considerations that is required to determine if a project will be profitable or not.
Right.
So thank you for that. So we're moving over to Mutiat.
Hi, everyone. Thank you so much to Monique and Carrie for that. It was a lot of information, and it was honestly like being in class, which I'm supposed to be taking a break from all in-depth studying, but it's okay. So I'm going to take us sort of back high, right? We've gone pretty granular into the specifics of what you need as a first-time home buyer, all the documentation you need to get in, sort of costs you should be factoring into your calculation to determine how much, property you can afford. And of course, Carrie has then taken us all the way to the end of when you have, turned your first property into this multi-million-dollar real estate empire, right? To invest or even become a developer on your own, like people like Carrie. So I'm going to try and sort of fit the in-between, right? From, maybe you're just starting, you have your first one, your first two, and you're wondering how you can really accumulate and probably, employ or implement sort of strategies like what Carrie and his friends did before they got to where they were as developers. So I am now going to share my screen. This is not the right one. Okay. Also, if I just have to excuse myself for 2 seconds, it will be because my son has decided to just not be nice to me, but I don't think that will happen. Is anybody seeing my screen? I'm trying to share, but it's not allowing me. Maybe I'll just do the whole window. It's
Nothing yet. Nothing yet.
Yeah, I don't know what's happening. Please work. Share. Okay, you know what? I'm just gonna go back on Google Chrome and we'll do it that way. Okay. So we're gonna do it.
Yep, it's come up now.
Okay, perfect. I'm gonna do it on PDF, but Canva it is. So today, let me just get into presentation mode. Like I mentioned, I just wanted to take us back high level and discuss, why we really need real estate in our wealth plan. So my goal is really just, again, to bring it back to basics and offer, alternative perspectives. So my approach to that would just be to kind of redefine real estate for us, right? Delve into why we need it, how to include it, a really, really, really quick case study, and then, with some parting thoughts to wrap us up for the evening before we get into Q&A. And I'll try to make it fast because I know we have just about, just about 15 minutes left. Okay, so the very first thing, wait, this is out of order. 2 seconds. Okay, well, we'll start here because we're here. So, the very first thing that I wanted us to think about is this number, right? I actually had to go research, like, what is really generational wealth? A single generation is 30 years. I'm 37 this year, so adding 30 years to my life is 67, and we're now in a place where our life expectancy is probably approaching 90s, right, at the minimum. And so what kind of quality of life can you really be expecting? How many more cycles of 30 years? I probably have close to 2 cycles. And this is just in my own life before we even get to the inheriting portion of what generational wealth really is, which is that it's moving from not just my life, but to my child's. And then we then try to think about what will really last that long, right? For my next 30 years, probably the next 20 some odd after that one. I don't want to live that long. And then have still be enough of equity, of value, of all these things that I can then transfer to my son, right? Like, what will last that long and what will last through it all? Obviously, real estate. So what is real estate really? Fundamentally, real estate is about property, it's about belonging, and it's about shelter. And I wanted to sort of bring all these conversations back down to that. And I think Carrie sort of alluded to that when he said, even when you're doing, a commercial real estate, you are still thinking about service to the community. And when you think about property as belonging and shelter, it then helps you to see that as a driver and an anchor for wealth is deeper than, this number of millennials currently don't have property or immigration and statistics. It helps you see that real estate is fundamentally about need and identity. And when something is about necessity and emotion, it lets you know that by hook or by crook, people are going to want it, right? People are going to want it, and they are going to do everything they can to get into it. In economics, we call it inelastic demand, which means that doesn't matter what's happening, it's going to consistently support that demand. And we see that, right? Monique had alluded to the fact that they're trying to introduce taxes, they're trying to bring in stress tests. All that is to show you that the demand is so hot that is driving prices so high that they have to intervene to bring it back down a little bit. That doesn't eliminate the demand. All of that is external to the actual market. That's somebody outside saying, we just want to cool it down a little bit. The demand is still super high, and supply still can't meet it. As Carrie again said, you can see all of the steps that it takes to even decide to get into a development before you then go through the construction process and all of that. And I don't know if people caught this, but Canada, we like to say we're immigrant friendly, and we are. But what is, even more, I don't know the words to describe here, but the kind of immigrants we bring in are really, really the best of the best in these countries. Like, I don't know if you guys, know anybody who's actually tried to become a migrant in Canada. They have stupid amounts of money. There's actually a class called investor class where you go and you literally bring like $1.5 million at the minimum, and that could be a way for you to get into Canada. So you're literally buying the passport. So these are people who, they have money, or they're very, very upwardly mobile. I'm Nigerian. Everybody in a Nigerian household has like 2 or 3 degrees and comes here and gets another one. And that's actually another way that people come into, Canada, through the student visa way. So this is just to let you know that the people that are coming as well, like it's such a high need for them, again, for identity as an anchor. So, bringing all of this together is really to show you that real estate really can be a foundation for your wealth. And for that to become even more of a reality, I'd like everyone to keep 3 things in mind. The first is finance over feelings. This is really, really critical if you want to be able to say, this is one property, you take the equity out, which I'll, get into in the case study, and then you're able to create other, income generating equity growing assets. You can't, even if it's the house that you live in, we no longer have the luxury of saying that, it's a nice house. We don't have the luxury of that single-mindedness anymore when we're now trying to decide what it is that we're putting $100,000 into. Just side note, I'm a realtor as well. I barely do it as a typical realtor like Monique, because I focus more on investment side. And I literally just helped my dad's friend, his daughter, so about my age, and they just bought a condo, $750,000 cash. And so like it's really important that if these are the people that you're competing against, your $100,000 that you're getting into the market with, you're being really, really smart, right? If you can't buy in the GTA and, it's your primary residence, you want to live in Oakville, you know what? Ownership over everything, right? Buy an income generating property in Niagara Falls, okay? Even if you're paying rent wherever it is that you want to live to support your lifestyle, you have something that is growing at the pace of the market. And I promise you one day it will meet. And when I say one day, I mean like in 2 years. So it's also not this indefinite thing of you having to wait for a really long time. And then the second point is to keep the idea of the estate in real estate separate from the individual property. When you do this, you start to see how you can do things like refinance, like get a mortgage. So this is what it means to refinance your property. You have equity that's been growing. So let me just use myself as an example. I bought my condo that I'm currently living in 2015. It was a pre-construction, $384,000. And then I moved in 2019. It was valued at about $450,000, $500,000 already. And at the end of March this year, somebody sold, so same 2-bedroom, 1,000 square foot at $725,000. Literally nothing has happened in the property. Like nothing has happened. And if I'm going to refinance now, even though I haven't actually added anything, my estate and my ownership of that equity is what I'm taking out. So it's not necessarily the physical shell, and I can do that over and over. So after I do that this year, it's going to have grown again in 2 years, and then I can take that again. So what I'm really taking out and what is multiplying is my estate. It's not the property. It's the same one property. But that's where the difference between something being estate and property, and keeping that in mind when it comes to the wealth generation aspect of what, the real estate can do for you. And the final is, wealth over riches, right? Real estate definitely can give you both, right? When we talk about people who want financial freedom, so they have a bunch of multifamilies that, is paying for their car, their this, their that. But the real beauty of real estate is what I've just mentioned, with being able to refinance, being able to take your mortgage, being able to take a home line of equity, out against your property at like $50,000, placing it with a mortgage broker, and then that $50,000 then goes on to finance people who want to do fix and flips, right? So, you take your $50K home equity line of credit, maybe you're paying $100, $200, against it every month, but you've taken that $50K, given it to a mortgage broker. This is a little hack for you guys. Giving it to a mortgage broker, and then that person is lending it at 20% per annum. Meanwhile, you're paying your bank or your lender, 3.5%, 5%. So look at that differential. You haven't done anything to the property. This is the estate and the value, and obviously tying that to the wealth. And this is before you even sell. This is before you do anything at all. So why we need it. I think there are 4 main things that I can think about why we really need to have real estate as part of our wealth plan. And the first is that, honestly, income is punitive and it is finite. Just think about your check, right? Even if you're, if you're a business owner, it's a little bit different, but think about your check, as an employed professional. Before it even hits you, everything has been taken out. Right before I left, I think I peaked at like 92,000 gross. But my actual take home was like 41K. And so it was almost like, why will I keep trying to be better at my job and get promotions only to pay more tax and not be able to transfer all of this effort that I'm using to get these increases in income into wealth? And this isn't to say anything against tax. Like, honestly, some days I'm like a socialist. no, in fact, I am most days a socialist. But, it's really the idea that income peaks based on the way our tax rules are set up. And so you really have to start to think outside of that and what it is that, can give you that ongoing wealth without you having to negotiate all the time. And which brings us to, the second point, which is you have to stop nickel and diming yourself, right? Work cannot fund your ultimate lifestyle. Like, you just can't do it, for all the reasons that I just mentioned. So I think it's time that we stop trying to negotiate, $5,000 every 2 years, right? And then, us feeling like we're actually doing something. It cannot. It's finite in the moment that you have earned it. And I actually just wanted to read something that I saw on Instagram. Paying my monthly rent that has tripled since 2001 with my paycheck, that's the same dollar amount my dad was making in 1993, then opening the newspaper and reading stories about why no one has kids anymore. And honestly, that is straight up facts. Daycare, I'm currently paying now $1,067, and my son goes from like 8:45 to 3:30 p.m. And that's just it. Oakville Soccer Club is gonna cost us like what? $200 for the summer, and then he's going to do swimming and painting and all those things. So that already tells you that you can't fund your lifestyle. And, I'm not even out here going to Cancun yet. You understand? So, it's just, we have to get real with ourselves. And then just bringing it now to the more wealth and long-term side is that the pace and stability of real estate make it worth it. Literally nothing that is stable right now is growing at the pace of real estate. And I'm not even going to spend too long on this. You guys are all financial experts and you're smart, so you know what I'm talking about already. And finally is that wealth cannot happen without ownership. Right now, most of us have to trade time for money. I'm not even about, demonizing that, right? Do what makes you happy. But in the end, you have to figure out how to convert that money, that income, whatever it is left once it hits your paycheck, hits your personal income. You have to figure out how to convert that into assets that are cash flowing and increasing in equity. Otherwise, the whole thing is just at a loss. So you can't have wealth without ownership. And that's really because you need to have discretionary powers over the economic outcome of your time and effort. And I hope that's clear and not too nerdish. So one of the hows, and I like that, so far in this presentation, we've covered two, more of the typical resale markets or properties that exist today. And we've gone again all the way down to developments, commercial developments, actually. So I'm going to sort of talk about the in-between of those, maybe if we can call it that, which is pre-constructions, with a soft nod towards, investing in developer financing through your self-directed RRSPs, which we can talk about that a little bit. But I like pre-constructions for 3 reasons, and here they are. The first one is that they are passive. You do not need to sacrifice time or effort to start and actually grow your portfolio. During Carrie's presentation, I don't know if people caught it, but he said that they literally him and his friends had to develop additional competencies, in managing property and fixing and flipping and all of these things. And again, he's a developer now. So I guess in the end, it's probably something that he was going to do. But for most of us who really just want to grow that wealth passively, we don't have the time really, right? You've done your job. The last thing you want to do is drive over to Windsor and see if your students are paying their rent on time. You know what I mean? But more importantly, you also don't want to sacrifice time right now, because with pre-constructions, you're able to lock in what the price is going to be. The price is set at today's value and you've locked it in for the future. So like in my example, I locked in the price at $384. By the time I was getting my mortgage, it was, already worth about $500. So already that increase is mine without even having to do anything. And more importantly, when you get the mortgage against the original value, not the appreciated value. So again, automatically you have equity. So if I chose to sell my property at that time, literally the day after I closed it, I would have been up like 80 or 90 grand already over a 3-year period. It's efficient, right? You don't have to become an active landlord or property manager because you have the condo corporation that does it for you. And of course, there are lots of elements into picking the right, pre-construction property, the project itself, the developer, the market, especially if you're thinking of it as an investor, Can it support higher rent over a long period of time? etc, cash flow, some of what, again, Carrie already discussed. But it is efficient in that you don't have to incur any outside charges. Everything you would need, to consider as an expense is already within, the unit. And so it just literally is plug and play. Like, get a realtor to get you a tenant, get them in there, and that's it, right? And that's literally all you need to do. And you're not constructing it on your own, right? So all of that risk of trying to get, the right, tile and all of those things, that's going to sell in this market, that's none of your business. Developers clearly have done a lot of due diligence in deciding the kinds of units that are going to be coming to market. So you literally will be benefiting from all of that pre-work. And the last point is wealth. You're not missing out when you invest in pre-constructions. Net worth, which is the equity, it grows even before the mortgage hit, like I said in my example, right? So these are things that when you're thinking from an investor perspective, you start to sort of put 2 and 2 together of like, why am I going to struggle in a resale market against people who have $750,000 in cash, against people who have other properties to pull out equity from? Why am I going to struggle with all those people and, get trades and all of that because I want to invest in real estate when there is a whole other side of the market that I feel like people really, really just disregard, and really to their own detriment. And so I wanted to use this as an example. So when I first started in real estate, I worked with my dad, and together we managed a portfolio for, it says 10 here, but they're generally about 15 people. I didn't include the other 5 because they really started to get into more commercial type properties. So about 10 of them stayed in the residential space, and literally all they did was condos. Literally, that's it. So they literally would just go to Tridel and say, hi, Mr. Tridel, Mrs. Tridel, we want to get a bunch of your condos. Here is obviously pre-construction. And it's 20% over however long, sometimes 18 months, sometimes 2 years. And they would actually decide to put 30% down, because what that does is that they are then able to hold for even 10, 15 years, right? So in between that 10, 15 year period, they're able to refinance a bunch of times before they finally sell. And so they put more down payment because that means your mortgage that you're taking is reduced, which then means that your monthly payments is reduced, which means that when things like COVID hit, or when, we couldn't increase rent for a certain period because the market couldn't support it, we didn't care because we had enough buffer in our cash flow already. And so, 10 people have $10 million in assets, $100 million in assets. And their last sort of group buying was Tridel's last project, which came to market. It's Islington Terrace. I got one in there as well. Yay, me. Islington Terrace. It came to market last summer, and they literally took 30 units. Right? I mean, they really could become developers on their own, but when you think about their age, like, they are the definition of passive investors. They literally don't want to do anything. And really, this is what you can do with pre-constructions. And if you think about it, it's not really that hard. It's 10 million for 10 people, for each person rather, over 10 years, with average, prices of anywhere from 600 to 700,000. Refinance at year 2, year 3. Do that 2 or 3 times of the asset is in your portfolio. And there you go. And you don't have to quit your job. You don't have to look for all these extra things. You just get your money right over 2 years, and then you're in. And I just wanted to leave us, with some last thoughts. Sorry, I'm blowing through this, but hopefully, people can ask me all the questions in Q&A. So some last thoughts, to again take it even higher level, is that there is a ton of insecurity globally. Like, we all know this. Geopolitically, environmentally, health, everything, and it's all interconnected. And that's forcing more people to Canada, people who have choice, people who have mobility. And they're coming here because, frankly, States is the States, and England is England. So we are probably, the next best option in terms of the Western world. And so that's going to just drive up prices even more. Boom and bust cycles, they're deepening, right? Like the troughs are going super low, the peaks are going super high, and it's happening even more frequently. So if your income can absorb it, do you have wealth that can absorb it? And so when I said earlier that, do you have something that can sustain over the first 30 years, right, of your generational period into maybe the next 30 years, which will then maybe, at least in my case, hopefully translate into, inheritance from my son. So like, this is how we have to think. Like, we literally don't have the luxury anymore. And they're exciting new areas. Obviously, there's crypto, there's NFTs. I personally am interested in all of those as well. Once an investor, you will always be curious about all the things. But for me, it's more important that we make sure that our foundation, at least 50 to 60% of our wealth, is in real estate. So, as Nigeria says, kata kata boast, you can still handle yourself. If anything is about to happen, right? Like you still have enough of a foundation in your wealth to really, be okay and really, take that. And finally, time is always going to pass. Growth is a reality. I'm so happy that Monique started us off with the presentation, because she was able to tell us that she started 10 years ago. My dad started, probably another 15 years before that. And that's just the fact of the market. It's so funny. He actually says that at one point he sold about a quarter of their holdings in downtown Toronto, because he said he just couldn't imagine that the prices wouldn't crash, and they just did not. So he sold off whatever he had and then bought again in Toronto, right? And so that's just what it is. Time will pass, growth will continue to happen. So it's really a question we have to ask ourselves frequently, right? Like, will it be in our favor as net worth, or will it just, keep us further and further locked out? And that's what I'd like to leave us with. And that's the last slide. Oh, right. I live on the internet. These are all the places you can find me if you wanted to carry on the conversation, or, just wanted to hang out. I'm in all the places. The top 3 I'm most frequently, you can find me easily. Trying to work on my LinkedIn, because everybody here is a LinkedIn buff. And anyway, but for now, email, Instagram, website. And thank you for having me.
That was great, Mutia. Thank you for the insights that you provided. I really don't see any reason why anyone shouldn't get into real estate right now. It just seems like you can't lose over the long term. So we're going to go over to questions. We're going to allocate about 15 minutes for questions and then 10 minutes for networking. I see that a lot of people have been sending their questions, which is great. So I guess I'm going to start with Monique. There was a question from Camille. How do you manage the adverse effects of capital gains on your flips?
That is a good question. You have to have a very good accountant. That's the key. That is the key. You have to have an army of professionals who you can rely on that are going to save you. That's who we rely on. We have an arsenal of people that we rely on, because I am not an accountant. That's their expertise.
Good to know. And what's the typical percentage that you pay for capital gains?
Yeah, so it could be anywhere from 30 to 50%.
Wow. It's good to know.
I add to that, though, I don't want that to be a deterrent for people.
It shouldn't.
Because the thing is, okay, you pay tax, give unto Caesar, right? Like, what have you gained? And if you're paying tax at the end of year 10, well, you've already refinanced 2 or 3 times. That means you've pulled out $300K already, and your tax bill is 75 grand. What does it do for you? Mm-hmm. Nothing. It doesn't affect you at all.
You have to think of it as a cost of doing business. That's really what it is.
Yeah, I'm sorry. I want to add to that as well, because I think, Mutia, you hit the nail on the coffin then. I mean, hold the real estate, right? And when you need to extract equity, do exactly what Mutia referred to. So refinance. And when you do refinance and pull that equity, kind of converting that equity to cash, there are no gains on that, right? And so you'll forever be able to access your equity in that way. So taking a long-term horizon to real estate is really the way to go. And that's the way to remain most tax efficient.
That's a very good point. So another question from Monique from Nimoy. Do you think it's possible to do due diligence in the current climate, considering certain sellers are requiring buyers to remove financing and home inspection conditions? What advice do you have for first-time buyers who face this issue?
Mm-hmm. So as I said in my presentation, I am very anal about who I work with. So I have a good working relationship with the mortgage brokers, lawyers who would need to look over perhaps a status certificate within the afternoon that we receive it before the offer date. And I make sure that the brokers have done their due diligence and that they can say confidently they will be fine for their financing. In regards to the inspection, your realtor is going to have to be very savvy and, be able to persuade the sellers to allow them to do the inspection before the offer date. You just have to be proactive. Yeah, I literally received a status certificate within 2 hours of the offer date, and I was able to get it reviewed and signed off by the lawyer.
I see.
Yeah, so you just have to have a realtor that's connected and can get things done for you.
Most certainly. Another question from Aldora. What advice or considerations would you give if you're looking to purchase your first property further away from your primary residence?
Is this for me?
Yes, for you, Monique.
Oh, sorry. Okay. So say that one more time. I heard you say a name. I wasn't sure.
So it was a question from Aldora.
Yes.
What advice or considerations would you give if you're looking to purchase your first property away from your primary residence?
Yes. I would say first consider what your budget is. I would advise to buy as close as possible to the GTA. I don't know where Adora lives, but my advice to clients has been to be as close as possible to the GTA or in emerging suburbs outside of the GTA. You have to, I take it a step further. When I have clients buying out of town, I literally contact the city, the municipality that they're looking to purchase in to find out what the site plans are, to see what would be growing in particular neighborhoods. Even if they're buying further out, you have to do that.
It's good to know.
Mm-hmm.
Question for Carrie from Nadej. Besides growth rate, population density, or location, are there other criteria to consider when looking at a potential site for development?
Yeah, no, great question. And sometimes we get very, very caught up in what I call like the desktop assessment of a property, right? So all of the finance. But in our early developments, early when we were buying multifamily, one of the things that we paid maybe too much attention to was just the financial analysis and not too much on the structural analysis of a property that you're buying, right? And so you need to really come at it from both angles. Sometimes when I refer to the cap rate or what your unlevered yield is on a property, sometimes it's a very high yield for a reason. It's you're purchasing potential. Oh, sorry, I got something that popped up here.
Yeah, for me too.
Still hear me?
I can, but it looks like we've exceeded our allocated time.
Is that right? Yeah. Okay.
Is everyone still there?
I'm here. Yeah, I'm here.
Oh.
I just don't know. I don't know if everybody on stage can still hear us.
Yeah. Okay. Can you move that pop-up window? That I can't move mine.
No, I can't either.
Okay.
Hi, I'm going to take over. Can you all hear me?
Yes, Jennifer.
Great. Okay. So I'm looking in the stage and also in the event and the chat. And this one, I guess, could be for all of you. So I guess maybe Mutiat, you could take this. It's from Stephanie Z. Is it better to invest in real estate personally, or when do you start investing in it via a hold co? Oh, I think Mutiat has gone. Okay. Carrie, Monique.
Mm-hmm. It's a good question.
Yeah, I don't know, Monique, do you want to jump in or?
Yeah, for us, it's by, I would say, property number 5.
Mm-hmm. And I think
Yes,
I think yeah, right. And I think that the assessment for us is there's a few moving parts to that. So all of our projects are limited partnership or a corp, right, or a holdco, you can control or have much more latitude when it comes to taxation. And so as you start to grow a portfolio, you definitely want to start considering structuring yourself a bit more in that way. I think one of the considerations, though, is financing starts to change quite a bit as you start adopting those structures. So buying a piece of real estate for yourself personally may qualify you for certain financing that you won't necessarily be able to qualify for if you are proceeding under, through some corporate structure. So, just a consideration on that front.
Thank you for that. So we have a question from Atiat from Camille. What are the taxes associated with lending brokers money for investments?
Listen, it was good.
Sorry, what are the taxes considered for? Oh, right. So basically when you take your money out and you give it to a lender, taxes really come into play once it starts to hit your income tax, right? So if you, and this is where I really just like to set up a corporation. Once it's outside sort of my regular income and I don't want it to hit my, regular personal income, I just do it, under a separate corporation. But if you're not earning that much or it's not hitting you directly, I don't really think it's that much of a factor. But in general, it'll be treated just like capital gains, right? So if you had taken out the 50,000 and, in a year you had earned, 20K, what you're going to be paying taxes on, is that 20K as part of your capital gains at whatever percentage that you qualify at. So, it's really important. I think just, as what, Carrie had said, what I decided to do this year is really to separate like my individual self from my business income self. And that's really by way of incorporating. So anything that I'm going to be doing is going to be under my corporation. So literally the corporation would pay me. So I know most of us here are probably, 9-to-5ers, so it might work a little bit differently. So of course, speak to, your tax consultant before that, but a lot of people are able to grow passive wealth through that. And it might just be that, you already have an income property or 3, and this is just like an additional, passive way, which means that you can probably just do it under your company anyway.
Right. And it's good that you brought up incorporation. What's the best way to go about getting incorporated?
I just called my lawyer. I just called my lawyer. I paid $1,200, but again, that's because I'm incorporating as a professional, not just as a holdco, right? So I'm actually going to be trading under that business name. So I would say, call a lawyer. If you wanted one, there's Vantage Law on Instagram. They're the ones that I used. They're specifically for real estate and they do financing as well. So if you were interested in that sort of blend, that could be an interesting way to pursue that. They're Vantage-Law on Instagram, and they're really great.
It's good to know. So we have a question from Monique from Karen. You spoke about the partnerships for first-time homebuyers. How do I get into this and secure my asset knowing that the co-applicant will not participate financially? Don't you think this would eventually become a conflict between me and the co-signer? Please clarify on that partnership.
Yes. So for myself right now, I am in the situation where I had to partner with a family member to get a purchase through for an investment property. So what we did is we created a trust agreement through your lawyer. They will construct an agreement that will protect each party. In the case where my situation is concerned, that particular party has a 1% interest, while we have 99%. And there's other terms in the agreement that stipulate the restrictions.
If I can add to that, one of the things that I think is really, really critical, in addition to the agreement, but I think even before you get to the agreement, I guess Monique's case is different because she is 100% the majority. Like, what could they even sue her for, right? But if you are doing more of like a shared structure where somebody's 20, somebody's 40, another person is whatever, what's the difference, 30 or 90? Then you have to get, I guess, a little bit more granular and clear. Like, how long are you each trying to be in partnership for, right? Like, you know, somebody wants to own property for 5 years. Somebody actually is looking at this as a stepping stone into creating some kind of, you know, business with it and really are holding it for a really long time. So I think it's important to talk about how long each of you want to be in partnership for. I was working with another group where one of them really just wants to invest in property and literally like take the egg and kill the goose, where she just wants to like refinance every so often, take all the income and spend it right away. And it's like, no, bro, this is not why you invest in real estate, right? So you need to be really, really clear before you even sign on paper that those kinds of risk elements are either eliminated or papered up very, very quickly, because yeah, you might need to start together, but understand that that might just be on the first one and you exit that quickly once you've each grown enough equity to go on your own. So still 100% pro partnership, but make sure you have those really, really ugly conversations and do the fight before you get in.
Yeah, most certainly. Okay, so I think we're going to be wrapping up with questions now. If you guys have any further questions, you can reach out to the speakers personally. And we're going to have about 12 minutes left for networking. And you can access networking by clicking on the networking tab to the top left of your screen.
So we go to networking now?
The tab should be on the left side of your screen.
Yeah. Okay. Bye.
Bye. Thank you.